Assalamualaikum warahmatullahi taala wabarakatuh. Today our group will present about the goal of the investment, alternative investment and the regulatory bodies in Malaysia. For the goal investment, we have two. The first one is personal and the second one is financial. So let's take a look for the personal. The first one is insurance protection. Young people often buy insurance when they start working for protection. Insurance provide financial support for family if something happen to the breadwinner. Return from insurance are usually low compared to investment. The second one is providing a home. A house is both a place to live, a long-term investment. Property value can be increased greatly over the time, and house can be rented out to pay the mortgage and generate extra income. The third one is emergency reserve. Everyone need to saving for unexpected expenses. The amount depend on monthly living costs. It is best set aside money immediately from income before spending. And the fourth one is education. Education is important for both children and adults. Costs for education are rising every year, and having enough saving encourage we don't miss opportunity due a lack of money.
Retirement is investing help with extra saving for a comfortable retirement beyond EPF. More funds are needed for medical expense as health decline with age. Proper retirement planning allow individual to life comfortability without depending on their children. Now is financial. First, we have a safety of principle. Investor aims to protect the original amount they invest and maintain its value. Careful analysis is needed to ensure the investment can be sold later without losing money. A safe investment should be easy to sell and have stable price. Second is portfolio diversification. Diversification means spreading investment across different securities to reduce risks. Holding at least 10 different investments help balance gains and losses. A well-diversified portfolio protects investors from major loss. Liquidity portfolio. Liquidity refers to how quickly an investment can be turned into cash without losing value. High liquid investments are easier to sell when money is needed urgently. Liquidity is an important factor when selecting which asset to include in a portfolio. Protection against inflation. Inflation reduces the purchasing power of money over time. Price of goods rise faster than income, so saving alone may not be enough. Investing in assets with return higher than the inflation rate help protect and grow well.
Next, we move to assurance on income and financial independence. A good investment plan provides stable and reliable income. Next, fixed income instruments like bonds and preferred stocks offer regular interest or dividends. And financial independence gives investors confidence and reduce fear of losing their job. Next, we move to types of investment risk. The first one is systematic risk. Systematic risk is a risk that affects all investment and cannot be avoided. It happens because of big events like economic changes, politics, inflation, interest rates, or war. Since these events impact everyone, the risk cannot be reduced. The main types are inflation risk, market risk, and interest rate risk. Next is unsystematic risk. Unsystematic risk is a risk that affects only one company or one industry, and it can be controlled or reduced. It happens because of specific problems like bad management, new rules, worker issues, changing customer preference, or losing an important client. Since these issues are unique to a firm, the risk can be reduced by diversification. The main types of unsystematic risk are business risk and financial risk.
So, moving on to the next topic, which is investment alternative. In investment alternative, there is investment in financial asset, and also there is investment in real assets. Under investment in financial asset, there is securities. Securities have items like treasury bills, common stock, bond, and preferred stock. For investment in real asset, there is real estate. For investment in real estate. So, as mentioned about treasury bills, Malaysian treasury bills are issued by the Bank Negara Malaysia to raise short-term fund, and it has maturity date less than a year. The advantage of treasury bills is that it has low risk because normally it was issued by the government, and the disadvantage of the T-bills is that the interest rates are low in comparison to other methods of investment. Next is common stock. Common stock refers to the equity or share investment that represent ownership in a corporation. The advantage of common stock is that it has a higher return expected. For the disadvantage, normally the common stock shareholder bear the highest risk in the company. The third one is bonds. Bonds are fixed income and securities where the issuer agreed to make income payment that fixed by the contract. The face value is RM1000, paid at the maturity date. The advantage of the bonds are as follow. First one is that bondholder face lesser risk. And for the disadvantage, the bondholder return normally fixed and limited, and to fixed interest payment.
Next is preferred stock, a hybrid security that has characteristic a bond and common stock. The par value is RM100. So the advantage is preferred stock are marketable in KLSC, and the disadvantage is return is limited or fixed amount, and the investor cannot participate excess earning. Next is investment in real asset, which is bond, refer to residential homes, land, and variety of form of income property. The advantage is safe and return are secure, and disadvantage is involve large amount of money. Lastly, is regulatory bodies in Malaysia, which is first is Bursa Malaysia. It's the main stock exchange in Malaysia. It's regulate and manage the trading of security, ensuring fair, efficient and transparent market operation. It provides rules for trading overseas market activities and protect investor by preventing misconduct. Next is Security Commission Malaysia. It's a regulatory authority for Malaysia capital market. It oversees market activity, licensing, takeover, new security issue. The SC ensure the market operates fairly, protect investor and enforce the Security Commission Act 1993. Thank you.